Welcome to the Financial Power Play, the podcast where hockey meets real life money talk. I'm Brett from Uptown Wealth Management, here to help hockey families and professionals create a financial game plan that works on and off the ice. From the rink to retirement, this is your go-to for real stories, smart strategies, and trusted advice. Let's drop the puck and dive in. Welcome back to the Financial Power Play. I'm Brett Cranston. And today, I want to talk about something that I think a lot of people are dealing with, but not enough people are actually talking about: money in motion. That might sound like a fancy financial term, but it's actually pretty simple. Money in motion when something major happens in your life and money starts moving. Maybe you receive an inheritance. Maybe you change jobs and now you have an old pension, group RSP, severance package, bonus, or stock payout to deal with. Maybe you're going through a divorce or separation. Maybe you sold a business. Maybe you sold a property. Maybe you're approaching retirement and now need to turn years of savings into actual income. These are big moments. And here is the thing. Most people are not prepared for them. Not because they're careless, not because they're bad with money, not because they do not care. It's because these moments usually come with emotion, pressure, deadlines, family opinions, paperwork, tax questions, and big decisions. And when all of that is happening at the same time, it is really easy to make a rush decision. That is why I always say this: when money moves, you need a game plan. You need to slow the play down. You need to look at the full ice. You need to understand what decision matters now and what can wait and what could use problems later. But in my experience, people do not usually make their big financial mistakes when life is calm. They make them during transition. They make them when something changes. They make them when they feel pressure to act quickly. They make them when they receive money and think, I should do something with this right away. They make them when they sign forms they do not fully understand. They make them when they take advice from 5 different people who do not know their full financial picture. So today, I want to walk you through what money in motion really means, why it matters, where people get stuck, and how to think through these moments in a more practical way. And of course, we'll tie it back to hockey a little bit, because that is how my brain works. All right, let's start with the first period. Why is money in motion? Let's start with the basics. Money in motion is any major life event where money is changing hands, changing accounts, changing purpose, or changing structure. It's not just, I have extra money. It is usually bigger than that. It is money tied to a decision. And that decision can affect your taxes, retirement, cash flow, family estate, insurance, and long-term lifestyle. Here's a few examples. Someone receives an inheritance. At first, they may think, okay, I now have this money. Should I invest it? This is the question most people jump to. But investing is not the first question. The first question should be, what does this money need to do? Do I need to set aside anything for taxes? Do I need to have debt that should be reviewed? Does this change my retirement plan? Should any of it stay liquid? Do I want to help my kids? Do I need to update my will or estate plan? How do I make sure I do not waste this? That is money in motion. For example, someone changes jobs. They get excited about the new role, new income, new title, and new opportunity. But then the old employer sends paperwork. There may be a pension decision, a group RSP, a deferred profit sharing plan, stock options. Your benefits may be ending. Insurance coverage is changing. Maybe a severance package, maybe a bonus payout. And now they're thinking, what do I do with all this? Again, this is money in motion. And here's another example. If you get divorced or you get separated, that can involve the house, pensions, investments, cash flow, child support, spousal support, insurance, retirement, taxes, and estate documents. It is emotional. It is stressful. And people often have to make financial decisions while they are also dealing with one of the hardest personal situations of their life. That is money in motion. And one more example. Sale of your business. A business owner spends 15, 20, or 30 years building something. Then one day, the business sells. Now there's liquidity. Maybe more money than they have ever had personally. But there are also tax questions, investment questions, retirement questions, estate questions, family questions, and identity questions. Because for a lot of business owners, the business was not just an asset, it was their life. That again is another money in motion. And then there's retirement. Most people think retirement is an age. It is not. Retirement is a major financial transition. You go through saving money to drawing income. You go from building assets to using assets. You go from getting a paycheck to creating your own paycheck. That shift is huge. Which accounts do you draw from first? When do you take your CPP? When do you take OAS? How do you manage tax? How much income can you safely spend? How do you protect against market volatility? How do you avoid running out of money? So when I talk about this niche, I'm not trying to create some complicated term. I'm trying to describe a real life situation. Money is moving. A decision is coming. The stakes are higher than normal, and people need a plan. All right, let's get into the second period now. Why people make mistakes when money moves. Now let's talk about why these moments are tricky. The biggest issue is not usually a lack of intelligence. The people I speak with are smart. They're professional. They're business owners. They're parents. They're executives. They have handled plenty of big decisions in their lives. But personal money decisions feel different, especially when emotion is involved. Let's take an inheritance. An inheritance can be one of the most emotional financial events someone ever experiences. Yes, money comes in. But usually that money came because someone passed away. A parent, a spouse, a grandparent, someone important to you. So this is not just a financial decision. There can be grief, there can be guilt, there can be family tension, there can be pressure to do the right thing with the money. And a lot of people freeze. Some people leave it sitting in cash for years because they are scared to make a mistake. Others move too quickly because they feel they should do something. Some pay off their mortgage without asking whether that fits their bigger plan. Some invest all of it at once without understanding their risk. Some give money to family without checking if they can afford it. Some spend more than they intend because it feels like found money. And none of these decisions are automatically wrong. Paying off debt can be smart. Investing can be smart. Helping families can be smart. Keeping cash can be smart. But only if it fits the plan. That is the key. The problem is not the action. The problem is making the action before building the plan. It's like jumping over the boards for a line change without knowing where the puck is. You might be fined, or you might create a bad turnover. The same thing happens with job changes. When someone changes jobs, they're busy. They're learning the new role. They're trying to make a good impression. They may be communicating differently. They may be dealing with new benefits. They may have a new income. They may feel like they are starting fresh. So when paperwork comes from the old employer, it gets pushed aside. And I get it. Nobody gets excited about reading pension transfer forms after a long day. But those forms matter. A pension decision can affect retirement income for decades. A severance decision can affect taxes. A group plan transfer can affect investment choices and fees. Insurance coverage can disappear before someone realizes what they lost. Again, the issue is not that people do not care. It is that life is moving fast. And when someone moves fast, money decisions can get rushed. Divorce is even more sensitive. I have to be careful here because I'm not a lawyer and I do not provide legal advice. But for a financial planning standpoint, divorce can change almost everything. Your income, your expenses, your housing, your retirement, your insurance needs, your estate documents, your tax situation, your ability to save, your sense of financial security. And people often need to make decisions while emotions are high. That is a hard place to be. You may just want it over. You may be exhausted. You may not want another meeting. You may not want to look at another document. But financial decisions made during separation can have long-term impact. So this is where slowing down matters. Not dragging things out, not making life harder. Just make sure you understand what each decision means before you agree to it. Business sales are another big one. Here's something I've been seen many times before. Business owners are excellent at running the business. They understand their revenue, they understand their staff, they understand the clients, they understand operations, and they understand risk. But when the business sells and the money becomes personal, it feels different. Now, the question is not, how do I grow the company? It becomes, how do I make this money last? That is a very different mindset. You may need to replace business income. You may need to replace investment process. You may need to plan for taxes. You may need support from your family. You may need to think about legacy. And you may need to decide what life looks like after the business. That is a big shift. And retirement is very similar to this. During your working years, a lot of people measure progress by account balances. How much is in the RSP? How much is in the TFSA? How much is in the non-registered account? How much is the pension worth? But once retirement gets close, the questions change. It's no longer only how much do I have, it becomes how much income can this create? And that is where planning matters. A portfolio is not the same thing as a retirement income plan. Having money invested is not the same thing as knowing how to draw from it. A retirement plan needs to answer practical questions. How much can I spend? What happens if markets drop early in retirement? How do I manage taxes? How do I coordinate CPP, OAS, pensions, RSPs, TFSAs, and non-registered investments? What happens if one spouse passes away? What happens if health expenses rise? These are not small questions. And again, the transition creates the risk. All right, let's move on to the third period, the biggest mistake people make. If I had to name the biggest mistake people make when money is an emotion, this would be it. They ask, what should I do with the money, before asking, what does this money need to do for me? That sounds simple, but it changes everything. Let's say someone receives $500,000. They ask, should I invest it? Maybe. But first, we need to know what the money is for. Is it for retirement? Is it to reduce debt? Is it to help kids with education or housing? Is it to create income? Is it to create security? Is it to protect against job loss? Is it to fund a lifestyle change? Is it to leave a legacy? Is it a mix of all of the above? The answer changes the strategy. Money with a short-term purpose should not be treated the same as money with a 20-year purpose. Money needed for income should not be treated the same as money meant for long-term growth. Money tied to taxes should not be invested like extra savings. Money that helps someone sleep at night may need a different structure than money someone can take risk with. That is why the first step is not product, it is purpose. Before investments, before insurance, before tax strategy, before account transfers, before anything else, what is the job of the money? That is the question. In hockey terms, every player on the ice has a role. Do not put 5 goal scorers out and hope for the best. You need structure. You need someone protecting the blue line. You need someone driving the play. You need someone creating space. You need someone who can win a draw. Your money is very similar. Some money is for safety. Some is for income. Some is for growth. Some is for tax planning. Some is for family goals. And some is for flexibility. If every dollar has the same job, the plan usually has problems. That is why I like to break money down into buckets. not in a gimmicky way, just practically. You might have a short-term bucket. This is the money you need within the next 12 to 24 months. Emergency fund, upcoming tax bill, home repairs, legal costs, living expenses, anything that cannot afford market volatility. Then you may have a medium-term bucket. This could be money for goals in the next 3 to 7 years. A home purchase, helping your kids, a planned move, a major renovation, bridge income, flexibility before retirement. Then you have long-term money. This is the money that can work for retirement, future income, estate goals, or long-term goals. Each bucket can have a different strategy. This is how you avoid treating all money the same, because all money is not the same. All right, let's go into overtime now. What to do first when money moves. Yes, I know hockey only has 3 periods, but there is an overtime period. But this is financial planning, so we're going to sneak in this overtime period. Let's talk about the first steps when money moves. Step 1 is pause. That may sound too simple, but it matters. Unless there is a true deadline, you usually do not need to rush. You do not need to invest everything tomorrow. You do not need to pay off every debt by Friday. You don't have to say yes to every family request. You do not need to sign every form immediately. You're allowed to slow down. That does not mean ignore it. It means create breathing room. The goal is not delay. The goal is clarity. The step 2 is organize. Get the facts in one place. What money is coming in? What money is coming from? Is it taxable? Is it registered or non-registered? Is it locked in? Are there deadlines? Are there fees or penalties? Are there legal documents involved? Are there family matters involved? What decisions need to be made now? What decisions can wait? Most people feel overwhelmed because everything is floating around in their head. Once you organize the details, the stress often comes down. Not always, but often. Step 3 is understand your tax. This does not mean you need to become a tax expert, and I always recommend involving an accountant when needed. But you need to know if tax is part of the decision. Inheritance may or may not have tax considerations depending on the assets and estate structure. Severance can create tax issues. Stock options can create tax issues. Selling a business can create tax issues. Selling real estate can create tax issues. RSP and pension decisions can create tax issues. Retirement withdrawals create tax issues. Tax should not be the only driver, but ignoring tax can be expensive. Step 4 is protect liquidity. This is one people miss. When someone receives a lump sum, they often feel pressure to put it all at work. But sometimes the best planning move is to keep some money available. Cash is not exciting. Cash does not make for flashy investment conversations. But liquidity gives you options. It helps you avoid selling investments at the wrong time. It helps you deal with taxes. It helps you handle emergencies. It helps you breathe. Not every dollar needs to be invested immediately. Step 5 is check your full plan. This is where a financial planner should help. How does this money affect retirement? Does it change your timeline? Does it change your risk level? Does it change your insurance needs? Does it change your estate plan? Does it affect your spouse? Does it affect your kids? Does it affect your mortgage strategy? Does it affect your business? Does it change how much income you need to earn? It's where people often miss the bigger picture. They treat the money as a separate event, but money in motion affects the whole plan. Step 6 is make the decision. Once you understand the purpose, taxes, timing, risk, and options, then you can act. Now you can decide whether to invest, pay down debt, transfer, gift, save, spend, insure, or restructure. The decision may still not be perfect. Financial planning is not about perfect. It is all about making a thoughtful decision with the information available. That is much better than reacting under pressure. All right, the last one. Examples of money in motion. Let's walk through a few examples. There are general examples, not personal advice. Example number 1. A couple in their early 50s receives an inheritance. They have a mortgage, they have kids in university soon, they have decent RSPs, but they are behind where they want to be for retirement. Their first thought is to pay off the mortgage. That might be right. But before doing that, we'd want to look at the interest rate, cash flow, retirement savings gap, education, costs, emergency fund, tax situation, and how much flexibility they want. Maybe they pay off part of the mortgage. Maybe they invest part. Maybe they keep some cash. Maybe they help the kids with school. Maybe they update insurance and estate documents. The point is not the one answer is always better. The point is that the inheritance should be connected to the full plan. Okay, here's another example. An executive changes jobs. They now have an old pension, a group RSP, stock options from the former employer, and benefits ending. They're busy with the new role, so they plan to just sign whatever forms get sent. That could be a mistake. Before signing, they should understand what pension options exist. Is there a commuted value option? Is the money locked in? What are the tax implications? What investment options are available? Do they need to replace life insurance or disability coverage? How does the new compensation structure affect savings? What happens to their stock awards? Again, not every option will apply to every person, but these questions matter. And here's another example. Someone is going through a separation. They're trying to figure out whether they can keep the house. This can be one of the most emotional questions in a divorce. The house is not just a house. It may represent stability, family, the kids' routines, a sense of normal. But financially, the question has to be tested. Can they afford the mortgage? Can they handle property tax, utilities, repairs, insurance, and maintenance? Will keeping the house weak in retirement? Will they have enough liquidity? Will they become house rich and cash poor? This does not mean they should sell. It means the decision needs to be looked at carefully. And here's one more example. A business owner sells their company. They receive a large amount of money. They feel relief. Then they feel anxiety because now the business income is gone. The money has to support the next phase of life. They may need an income plan, investment plan, tax plan, estate plan, and maybe even a plan for what they want to do next. Some business owners struggle after selling because their identity was tied to the business. That matters too. Financial planning is not only numbers on a spreadsheet, it is life planning with financial consequences. And here's another example. A couple is approaching retirement. They have RSPs, TFSAs, a pension, CPP, OAS, and non-registered investments. They want to know if they can retire. The answer is not just based on the account volume. We need to look at spending, taxes, timing, inflation, risk, income sources, health, estate goals, and what happens if one spouse lives much longer than the other. Retirement is one of the biggest money in motion events. You are moving from accumulation to income, and that takes planning. The emotional side of money in motion. I want to spend a few minutes on the emotional side because this matters. People often think financial planning is all math. Numbers matter, of course, but the emotional side can drive the decision. Inheritance can come with grief. Divorce can come with anger, sadness, fear, or exhaustion. Job changes come with excitement or uncertainty. Retirement can come with freedom, but also identity loss. Business sales can come with pride, relief, anxiety, and a strange feeling of what now. And when emotions are high, people can make decisions that feel right in the right moment, but do not fit long term. This is why having someone outside the situation can help. Not someone to tell you what to do without context, not someone to push a product, someone to slow things down and ask better questions. What are you trying to solve? What are you worried about? What would you make feel you secure? What decisions are you being pressured to make? What happens if we wait? What happens if we act? What are the trade-offs? Good planning creates space between the event and the decision. That space is valuable. Because when you have space, you can think. And when you can think, you usually make better decisions. What not to do when money moves. Let me share a few things I would avoid. Do not rush to invest everything. Markets will still be there next month. There's no prize for making a fast decision with money you do not fully understand yet. Do not take advice from people who do not know your full picture. Your neighbor may mean well, your cousin may mean well, your coworker may mean well, but their situation is not your situation. Do not make big gifts without checking your own plan first. Helping family can be wonderful, but you need to make sure you're not creating future stress for yourself. Do not ignore tax. Again, tax should not control your every decision, but it needs to be considered. Do not forget insurance. A major transition can change your risk. Job changes can affect benefits. Divorce can affect coverage needs. Business sales can change protection needs. Retirement can change estate planning needs. Do not assume the old plan still works. A major life event can make the old plan outdated. That does not mean everything has to change, but it should be reviewed. Do not confuse activity with progress. Moving money around does not always mean you're improving the plan. Sometimes the best first move is getting organized. The role of financial advisor during money in motion. So where does a financial advisor fit into all of this? In my view, the role is to help you make better decisions during moments that matter. That includes helping you organize the facts, clarify your goals, understand trade-offs, coordinate with other professionals, build an investment strategy, review retirement income, think through tax-efficient options, protect against risks, plan for income needs, prepare for future decisions, and maybe most important, help you avoid emotional, rushed, or disconnected decisions. I do not think advice should be complicated for the sake of sounding smart. You should understand what is happening with your money. You should understand why a recommendation makes sense. You should know what the next step is. You should feel like the plan is connected to real life. That is how I like to work. Clear conversations, plain language, no pressure, no jargon, a practical game plan, and yes, I'll probably use a hockey analogy at some point, but that is just part of the package. How this connects to hockey, now let's bring the hockey piece in. 4 years I've worked and around hockey families, players, coaches, and people connected to the game. And I still love that community. That is not going away. But I've also learned something important. A niche has to be more than an identity. It has to connect to a problem people are ready to solve. Hockey parent is an identity. Money in motion is a trigger. That is the difference. The hockey theme still matters because it reflects how I communicate. I like simple language. I like practical planning. I like structure. I like the idea of building a game plan. I like helping people slow the play down. But the financial need is the transition. And that is where people need advice. That is where money moves. That is where relationships can form. That is where decisions matter. So the hockey theme becomes the way I explain things. The niche becomes the moment the client is living through. And I think that is a better fit. Because if you are a professional, a business owner, a family, or someone going through a major financial decision, you may not care that much about hockey, but because you probably care about not making a costly mistake. You care about protecting your family. You care about retiring well. You care about making smart decisions with money you work hard for, inheritance, received, or are not responsible for. The core, that is the core. The checklist, questions to ask before you act. If you're listening and you have money in motion right now, here are some questions I would ask before making major moves. What changed in my life? What money is moving? Where is the money coming from? Is there any tax issues? Is there any legal issue? Is there a deadline? What decisions are urgent? What decisions can wait? What does this money need to do? How much should stay liquid? Do I have debt that needs attention? Does this change my retirement plan? Does this change my income needs? Does this affect my spouse or kids? Does this affect my insurance? Does this affect my estate? What happens if I do nothing for 30 days? What decision would be hard to undo? Who else should be involved, such as an accountant, lawyer, or mortgage professional? Those questions may not answer everything, but they will slow the play down. They will help you move from reaction to planning, and that alone can make a big difference. A word for people who feel embarrassed. I also want to say this. If you have money in motion and you feel unsure, that is normal. You are not behind. You are not supposed to automatically know what to do with an inheritance, pension package, divorce settlement, severance payout, or business sale proceeds. Most people are dealing with these things for the first time. You may be excellent at your career. You may be great at running a business. You may manage your household well, but this may still feel unfamiliar. That is okay. You don't need to have all the answers before asking for help. In fact, that is usually the point of getting advice. You bring the situation, the advisor helps bring structure, you bring the questions, the planning process helps sort them out. You bring the goals, concerns, and real life context. The plan turns that into next steps. So if you still feel stuck, do not beat yourself up. Do not ignore it forever. Money in motion needs attention, not panic. Attention. What a good fit first meeting should look like. Let's talk about what a first conversation should look like. In my opinion, the first meeting should not feel like a sales pitch. It should feel like a conversation. The advisor should want to understand what changed. Why are you reaching out now? What decisions are you facing? What are you worried about? What have you already done? Who else is involved? What would make you feel more confident? What do you want the money to do? What are you trying to avoid? The first conversation should help both sides understand whether this is a fit. You should not feel pressured to move money right away. You should not be pushed into a product before your situation is understood. You should leave with more clarity than you came in with. Maybe the next step is a full financial plan. Maybe the next step is gathering documents. Maybe the next step is speaking with your accountant or lawyer. Maybe the next step is doing nothing for a short period while you get organized. That is okay. The goal is not to force the play. The goal is to make the right next play. Common documents to gather now. If you're preparing for a financial planning conversation during a money in motion event, here are some documents that may help. Recent investment statements, bank statements, mortgage details, debt information, insurance policies, pension documents, severance letters, group RSP or benefit packages, tax returns or notice of assessments, will and power of attorney documents, business sale documents if applicable, divorce and separation documents if applicable, estate documents if inheritance is involved. You may not need everything for a first call, but eventually good planning needs good information. The more complete the picture, the better the advice. Why does this matter right now? I think this topic matters because more Canadians are going to face money in motion moments over the next decade. Parents are aging, wealth is transferring, people are changing jobs more often, business owners are thinking about succession, divorce and separation continue to create financial complexity. Retirement is becoming more personal, because not everyone has the same type of pension or income structure. And many people are making these decisions without a coordinated plan. They may have an investment account, they may have a mortgage person, they may have an accountant, they may have a lawyer, but no one is helping them connect the dots. That is where financial planning can add real value. Not by pretending to replace the lawyer or accountant, but by helping coordinate the financial picture. Because money decisions do not happen in isolation. A tax decision can affect cash flow. An investment decision can affect retirement income. A pension decision can affect estate planning. A divorce decision can affect housing. A business sale can affect identity, income, and legacy. Everything connects. That is why a game plan matters. And here are my final thoughts. So let's bring this home. When money moves, mistakes can get expensive. That does not mean you need to be scared. It means you need to be thoughtful. If you receive an inheritance, pause before making big moves. If you change jobs, review the money and benefits you left behind. If you're going through divorce, understand the long-term financial impact before agreeing to major decisions. If you sell a business, build a personal financial plan before investing the proceeds. If you're approaching retirement, create an income strategy before flipping the switch. The goal is simple. Slow the play down, look at the full ice, understand your options, build the game plan, then make the move. That is what money in motion planning is all about. Thanks for listening to Financial Power Play. If today's episode hit home because money has recently moved in your life, or you know money is about to move, I'd be happy to help you think through the next steps. It could be an inheritance, a job change, a pension decision, a severance package, a divorce or separation, a business sale, a real estate sale, or retirement. Whatever the situation, the first step is not rushing into a product or making a quick decision. The first step is getting clear. You can connect with me on LinkedIn, Instagram, or through my website at uptownwealthmanagement.com. If you know someone going through a major financial transition, feel free to share this episode with them. Because when money moves, you need a game plan. I'm Brett Cranston. Thanks for listening and hope to hear you at the next episode. Thanks for tuning in to the Financial Power Play. If this episode sparked something for you, be sure to subscribe, share it with your hockey crew, and leave a review. Want to talk about building your own financial playbook? Visit uptownwealthmanagement.com to book a free consultation. Until next time, stay focused, stay flexible, and keep playing your game.